Imagine loading a barbell with 500 pounds, straining to pull off one massive rep, and then walking out of the gym. That single effort does not actually mean you have built real strength. Real physical strength is built quietly. It comes from showing up every single week, managing your fatigue, and adding a fraction of a pound to the bar over months of disciplined work. Trading operates by the exact same physical logic. Hitting one massive account-doubling month is incredibly easy to mistake for real trading skill, but it is deeply deceptive. When you rely on huge, erratic profit spikes to grow your account, you are operating on a casino model. The adrenaline is high, the sudden wins are thrilling, but those vertical leaps almost always pull back into devastating account crashes. A serious trader treats the market like running a quiet neighborhood fruit shop. You aim for a calm, predictable curve of small profits that look completely boring on a day-to-day basis. A single, oversized win rarely proves you have mastered the market. Usually, it simply proves you over-leveraged a trade and happened to get lucky. This creates a difficult trap for developing traders. You have to evaluate your own performance and figure out if you are actually acquiring skill or if you are merely surviving a temporary streak of good variance. This chart shows exactly what a consistently profitable equity curve looks like. The data maps genuine trading performance over a verified 3-month period. Notice the trajectory. It is remarkably smooth and steadily upward. Losing trades occur, but they register as small, easily absorbed dips that never threaten the baseline account balance. Look at what is mathematically absent from this timeline. There are 0 erratic spikes upward and 0 sharp, uncontrolled crashes downward. Building an equity curve like this requires a specific trade-off. You have to willingly give up the dopamine hits of fast money and commit entirely to slow, methodical execution. To build wealth that you can reliably scale over time, you must let go of the desire to get rich quickly. To measure your progress, you run what is called a consistency check. This is a strict, objective, pass-or-fail evaluation of your recent trading profitability. If your profit and loss statements look erratic, a big win one month, a huge loss the next, you fail. Your trading is behaving like a volatile slot machine instead of a stable business. Failing this check triggers an immediate, mandatory protocol. You do not increase your risk parameters, and you absolutely do not randomly switch your strategy to chase better results. Instead, you enter the performance review loop, the diagnostic process to figure out why returns won't stabilize. You open your trade journal, reviewing historical actions line by line for mechanical mistakes. Then, identify emotional errors breaking rules, and tighten weak setups straining your account. Returning to this loop is like reviewing game tape after a loss. It isolates your behavioral errors so you can fix them directly, rather than vaguely blaming the market for a bad week. You pass the consistency check by demonstrating stable, smooth profits over several consecutive months. This success creates its own psychological trap. After a brief winning streak, your brain will urge you to double your position sizing to quickly capitalize on the momentum. The protocol for passing is incredibly strict. You keep your position sizing exactly the same. You leave your risk percentage exactly the same. Think of driving down a smooth highway. Just because the road is clear doesn't mean you recklessly press the accelerator. You maintain your safe speed. You have to actively suppress the overconfidence that naturally creeps in when your trading system feels completely infallible. Passing the consistency check does not earn you a license to start gambling with larger stakes. It means you have successfully proven your discipline, and your responsibility is to maintain it. To understand when you actually earn the right to scale up, we look at the skill horizon. Over enough time, the market mathematically exposes the truth about a trading strategy. A single month of stable profits is statistically irrelevant. The sample size of actual trades is simply too small to prove you possess an edge. Let's be direct. One good month means absolutely nothing. It is a dangerous milestone because it creates a false sense of superiority before you have tested your strategy across varying market conditions. Pushing that stability out to the 3 to 6 month mark gives you a larger sample size. This is your first genuine verifiable indicator of progress. The ultimate threshold is 12 months. Surviving a full calendar year of differing volatility, news cycles, and seasonal shifts while maintaining steady profits, that is the definition of real skill. Reaching that 12-month mark extracts a heavy psychological toll. It requires a full year of deferred gratification and incredibly strict ego management. Time is the ultimate filter. It is the only metric capable of grinding down pure luck until only your verifiable mathematical edge remains. Operating within that 12-month skill horizon builds unshakable, data-backed confidence in your own abilities. When you completely trust your data, the anxiety fades. True confidence translates directly into calm, almost completely emotionless trade execution. Compare that quiet execution to the constant anxiety and adrenaline spikes of the boom and bust gambler, whose entire net worth swings wildly on the outcome of a single setup. Calm execution is not an optional personality trait. It is a mandatory, non-negotiable prerequisite for preserving and growing capital over decades. You have to make a permanent choice. You must choose the boring, highly predictable business model over the thrilling, destructive environment of the casino. Scalable wealth is never unlocked by landing one lucky trade. It is a privilege earned exclusively through months of documented consistency and ruthless emotional control.